Stocks are crashing from their highs, with the market suffering its worst day since 2022 last week, and heavyweights like Tesla and Nvidia down double digits. Investors are rushing to hit the sell button, but have you ever sold a stock only to watch it rebound higher? Have you ever held on to a losing stock, watching it sink lower and wish you sold sooner? So the question is, when should you sell a stock? If you think about it, it's the only investing question that really matters. Until you sell a stock, any return on that investment is just on paper. You haven't booked that return until you sell. And most people say they're investing for the long term, but data says otherwise. Data from the New York Stock Exchange shows the average holding period for a stock has plunged from an investment of 8 years in the 1960s to just 5.5 months. Investors are selling their stocks in less than half a year. I'm going to reveal the only 3 reasons to sell a stock for a profit, and then 4 rules for when to sell at a loss. Make sure you stick around because the rules for selling in one scenario at a profit are different for when you sell at a loss. I'll also show you an alternative strategy to selling so you can ride your stocks higher while still locking in those hard-earned profits. And of course, the best time to sell a stock is at a profit. So let's start there with the 3 rules for when to sell your stocks that are going up. But understand, you're not selling just because the stock price has gone up. I see too many investors getting excited and selling a stock that has jumped higher after a quick 30 or 40% return. Headlines start saying things like too far too fast, and analysts start warning of getting overly excited. For example, investing in shares of Nvidia June 2016, you would have doubled your money in just 5 months, but hold on to a great company and it went 16x in 5 years. Amazon produced a 96% return in less than a year from its 2002 low. Take that profit and you would have missed out on your chance to get 181 times your money. Nation, the fact is the stock market is pretty smart and forward-looking. If a stock is booming higher 20 or 30% and more in a short period, there's usually a very good reason why. Yes, it might give back some of that return short term, and it sucks to see a windfall evaporate, but it's more likely that that competitive advantage that the company has that caused that boom is going to continue long term to take the shares higher. So we're not selling just because the price has gone up, but there are other reasons to take that money and run. And the first is to just rebalance your portfolio. This is when 1 or 2 stocks have shot up so far that your portfolio is basically just those stocks. For example, let's say you had a portfolio of $100 in Tesla and $100 in that broad S&P 500 stock index in 2019. Within a couple of years and a 14 times return on Tesla, you would have 90% of your money in just the one stock. Now, that's obviously an extreme example, but it does happen. I've seen investors with portfolios almost entirely in just 1 or 2 stocks. And folks, no matter how great a company is, you never want to bet your financial future on just one stock. Fail to rebalance, and that 15x windfall with 90% of your money in one stock crashes along with that stock. For that reason, I usually limit the percentage of my portfolio in any individual stock to no more than 5 or 7 or even as high as 10%. You could make the case for higher if you really like the company, but once the stock reaches 20% or more of your total wealth, you need to take some of those profits and just spread your risk out into other stocks. And rebalancing is as simple as putting some of that money in your other favorite stocks, or just putting a little more in the broader stock market ETFs, like the Invesco NASDAQ 100 QQQ, spreading your risk across 100 stocks instantly. We're just getting started, but one of the best ways to know when and at what price to buy or sell a stock is through what's called technical analysis. To help you out here, I'm relaunching my technical analysis course with a 30% discount. Save 150% off the regular price. The complete course includes more than 30 videos on how professional investors trade stocks, the buy signals, the sell signals, and the technical analysis they use. You'll also get the bonus material on fundamental analysis, trade examples, and trading worksheets to follow your trades. Click through the link I'll leave in the description and check out the free preview or try it risk-free for 14 days. You'll learn how to find the stock trades and never run out of ideas, how to identify price changes before they happen, and the top trading patterns used by professional traders. That relaunch discount though, save $150 off, is only running for the next 3 days or the first 40 students, so make sure you check out that link below. Your second reason to sell a stock for a profit is if the company gets bought out. You might not have a choice here. If the company you own is acquired for cash, then you're going to get the cash value when the deal closes. If it's a stock-for-stock acquisition though, meaning investors get shares in the buying company for every shares of the acquired company they own, you're going to probably want to take that money and run. That's because the average price in acquisitions is 30% higher than the market price. Investors get a quick 30% bump when the company they own is bought out by another. After that, returns are not so great. Multiple studies by the Fuqua School of Business at Duke and the University of Washington shows returns for buying companies, the stock you would get if the stock you own is acquired, produce substandard returns for years after the deal, less than half the return you got before the deal. So if a stock you own gets bought out and you get the shares of that buying company, unless you really love that buying company, sell and take the money. Let's look at the third reason to sell for a profit. Then I'm going to reveal an alternative to selling and 4 rules to sell a losing stock. And this one is what most investors think of when selling: risk of a stock bubble or the drop in that one stock or an overall market crash. But surprisingly, this is the weakest reason to sell because we don't want to be trying to time the market here. An expensive stock can keep running higher, and a bubbly market can just keep inflating. Before the 2008 crash, analysts and so-called experts were calling it a bubble as early as 2004. Michael Burry not so famously started warning of a crash that year, before a 60% run in stocks over the next 4 years. So here, even if you're very sure on this, I would only start selling a portion of my stocks. Only if the market is grossly overvalued and the Fed is looking to start raising interest rates, and then start by only selling 10% of your stocks every 3 to 6 months. That's going to lock in some of those returns, give you the opportunity to rebalance into safer investments that won't fall in a crash, and take advantage of lower stock prices if the market does come down. Now, I want to give you an alternative to selling a stock that is running higher because, why sell a stock that's doing what it should? You want to ride that gravy train for as long as possible, and here's how to do it with less risk. Our alternative is called the covered call strategy, and I'll use an NVIDIA here as an example. Say you went big into NVIDIA a few years ago and have seen that massive run in the shares, but now you're a little worried about the future, or maybe you just have too much in one stock. You can go here to the options tab, and this is a strategy you can use on any investing platform. There are weekly, monthly, and even long-term options available, but we don't want to be doing this every month, so I'm going to use the long-dated January 2026 options. That means the options we're selling against our stock expire on that date, almost a year and a half from now. And we can scroll down through these call options, and the price in blue here is called the strike price. It's the price at which you're going to allow another investor to buy the stock from you. You're selling them the option to call or buy the stock from you. So we scroll down, and we want to give NVIDIA some room to keep on going. So we're going to agree to sell it for $150 a share. You can see that still gives us another 29% upside on the shares. But here's the really great part. For that option, the other investor is paying us $20.60 a share right now, money you get immediately in your account. In effect, you're transferring some of that risk in shares of NVIDIA by selling these options. So that $20 cash you collect, divided by the current stock price of $116 a share, you're collecting an almost 18% return on the stock. Shares of NVIDIA could fall by 18% and your portfolio wouldn't be hurt because you collected that money. Think of it another way here. If NVIDIA moves above $150 each by that expiration date, then you get that amount for the shares, plus the $20 you already collected. That's an additional 47% return on your shares, along with major risk reduction. Now, I know options investing can seem like a foreign language, so I'm going to link to a video in the description that goes into more detail, as well as a special coupon code on my full options course with 29 strategies. Now, most investors don't think to sell a stock at a loss, instead holding on too long to their losers, just hoping to get back to even. Selling those losing stocks early, though, is one of the most important decisions you can make, saving you money to push into your winners. So I want to give you 4 rules for when to sell a stock at a loss. And again, just like we saw earlier, we're not talking about selling just because the price has gone down, though. You bought that stock for a reason, hopefully because you researched the company and liked that long-term outlook. When a stock falls, the best lesson you can draw from it is evaluating what went wrong in your analysis, or if you were just early on the stock. Even if you do plan on keeping that stock, one of the reasons you might sell is to save on taxes with tax loss harvesting. That's because you pay capital gains taxes every year on any stocks you sell for a profit. Long-term cap gains can be as high as 20%, and short-term gains are added to your income and taxed as high as 37%, but you can offset your profits with losses. That means any loss you take after selling a stock reduces the amount of total capital gains and the taxes you'll pay. Now, if you do want to hold on to that stock long-term, but also want to use some of that loss to lower your taxes, you can buy it back, but not within 31 days. So that means you don't want to sell your stock if an earnings report or news is expected within the next 30 days, but you can keep general exposure to that investment by buying an ETF in the theme or just a related stock. For example, say I wanted to use some of the loss on my shares of ChargePoint holdings, but still want to keep my position in that long-term upside. I can sell my CHPT shares and buy competitor EVgo, which tracks ChargePoint very closely, or buy the Electric Vehicle and Future Mobility ETF, ticker KARS, for that overall theme. So this tax loss selling isn't the kind of selling investors usually think of closing a position for good, but can save you thousands of dollars in taxes. Another reason to sell a stock, even at a loss, is if you're going to need that money in less than a year. This one hurts because for a lot of those loser stocks, you just know deep in your bones that they're going to rebound if you give them time. But here, time is something you do not have. If you need a big chunk of that money for something within the next year to pay for expenses, for school tuition, anything that can't be put off for later, you need to get it out of the stock market. And folks, I know interest rates on savings and CDs are crap, but the stock market is no place for this short-term money. Any big bills you need to cover in 6 months or less need to stay in cash, and anything even 6 months to a year shouldn't be in any investments riskier than treasuries, CDs, or money market accounts. Reason 3 to sell a stock at a loss is on news or material change in the company's outlook. Basically, something that forces a major change to why you bought the stock in the first place. Now, every investor needs to keep a spreadsheet or some kind of notes for each stock in their portfolio. Here you're going to write out not just the reasons you bought the stock, but also that bear case, kind of like a pros and cons list for the company. Note any competitive advantage you think the company has, along with market share versus its peers and its valuations. I know this is a hell of a lot more work than just letting some Yahoo on YouTube pick your stocks, but folks, you need to take responsibility for your money. It's only with tracking your stock analysis that you're going to be able to go back if the price falls and evaluate why it went wrong. Then you can decide whether the reasoning has changed enough to sell the stock, if you want to hold on, or maybe even add more shares to lower your price. But above all, this is the only way you learn from your mistakes to become a better investor. We still got one more rule for when to sell a stock, but if you're wondering where to put that money or worried about your hard-earned profits, check out this video next for the 7 safest investments ranked. 7 investments with returns of 8 and 12% plus that won't let you down. This 4th reason to sell is a dangerous one when you've found another stock that you want to buy. I say dangerous not because it's not a very smart decision when it needs to be made, but because we investors are like cats chasing that damn red dot. It is so easy to jump around from stock to stock and never catch the returns we need. But there is nothing wrong with ditching that dog of a stock if you've done your research and found another with higher return potential and a higher level of confidence. Revisit the research for your losing stock, compare it with this new research, maybe even sleep on it for a couple of nights, and then make that decision that keeps your money working for you. Don't miss the relaunch of my Stock Signals course. Look for the link in the description and save $150 off. See the technical signals professionals use and exactly when to buy and sell a stock, or click on the video to the right for the 7 safest investments ranked. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.